Hey, it's Jason Rogers here, and this is going to be part 2 of Dodgy Deals in 2020. I really want to talk about some of the deals I've passed on and some of the dodgy things, the questionable things I've come across and we've come across only in the last 6 or so months, because I hear so many of you who are looking to buy businesses, you're ambitious, or maybe you're an investor and you're thinking about placing capital in smaller companies. Maybe you're trying to buy a minority stake or even a majority stake in a seven-figure deal, a seven-figure company. And I just want to be very transparent about the things I've seen, and it hasn't all been pretty. So let's dive right in. The first deal I should bring across was actually the most transparent of the deals from which I've passed on, but in its own right, it had a big fundamental flaw. This was a plumbing company in the state of Florida, and this was a company that actually had perfect books, which is rare. It's very rare that a small business, a seven-figure business, has very clean books. But this company had perfect books from everything we could see. That was because there were two business partners. One was in charge of operations. The other was in charge of the accounting. He was actually a CPA. So they had perfectly clean books. But in our first day of due diligence, once we got the company under contract, I jumped on a discovery call with the operator, the chief operator, with two of my business partners, and we asked a number of questions. And essentially, this was a business wherein without this owner-operator, the plumbing guy, to be day-to-day engaged in the business, without him there turning the wheels, the business would not function. He literally told us he showed up at 6 in the morning, Monday through Friday, and he was on call all the way till about 6 p.m. at night, so about 12 hours, Monday through Friday. If he wasn't there, the business wasn't going to operate. They didn't have anybody else that could do specific tasks in the business that he did, and it was essentially a business that wasn't really a business. It was a glorified job. It was a glorified supervisory job that they were trying to sell, masquerading as a true business. And I would implore you to ask yourself, if the key owner is no longer there and the business does not function, is that really even a business? In my opinion, no. Which was why when I heard what I heard, we wrote to the representative that the sellers had and immediately said, we're out. We immediately took our ball, we went home, we left that seven-figure opportunity because we didn't feel it was an opportunity at all. So that's actually the least dodgy or least questionable of the deals, in that the financials were accurate. I believe the business made the amount of income that they proposed they made, but it was how they did it that was questionable, and it would have put me in a position where I needed to be an owner-operator. And with my ambitions, that's not what I want to be doing, and I imagine that's not what you want to be doing either. You want to ostensibly be able to oversee management as opposed to being management. This business had no management that was built in, and that's a huge mistake as a side note. I mean, if you're trying to sell a business and you never think about how to get yourself out of your own business, then you're basically not creating an asset that's going to be desirable to be bought by another buyer, right? You need to create management, as a side note, in my estimation. I'm pretty sure you would agree. You need to create management so that if you go on vacation, or if you have a health issue, or if you have a wedding, the business keeps making money without you being there. That's the true sign of a good business. But okay, let's get into the dodgier of the deals. The next one was another plumbing company in Florida. And this was a company where everything looked good at first. The books looked good, the operations looked good, the owner seemed transparent, he and I got on well, and yet, and by the way, this is not the same Florida deal, the same Florida plumbing company deal I talked about in my last episode of Dodgy Deals. That's a story in and of itself. I'm not going to talk about that story here, but you should watch that video. I implore you to do so. There's a lot of important lessons to be learned there, and it's a pretty funny story, if I do say so myself. But this was another example of a company that was looking great on the outside. And then once we dove into the books, their accounting procedures were absolutely garbage. I don't know another way to say it. They really were garbage. We could not tell what percent of the revenue came from certain sources. They just categorized revenue. That was it. We didn't know who their major clients were. We didn't know what percentage of the revenue came from individual clients. We also didn't really have an understanding of where the expenses were. They miscategorized office expenses. Office expenses are like 10% of their total expenses, even though it's a plumbing company. Shouldn't have a lot of office expenses. I mean, how much paper, how many staples do you really need to be successful? And so it was the classic example of books that could not be trusted at all. And as I started asking questions, the owner just kept on telling me, you can believe it, it's not a problem, it's not a problem. And yet there was no clarity whatsoever about what we were buying. There was none. And then this was a conversation I was having with this owner right around the time when the pandemic broke out. Then next thing you know, I get the year-to-date numbers, and the year-to-date numbers were just declining fast, super fast. Their profit, their revenues, all of it were just going down, 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 down. And yet sure enough, once I brought this up to the owner and said, look, it doesn't look like your company's worth what you were asking, I think we're going to need to discuss a price reduction. And of course, the owner was not interested in that conversation. No, my business is worth what it's worth. That's just the way it is. And that's what you'll find with a lot of these owners is they reverse engineer. I'm going to tell you another story that's actually the dodgiest one of all, other than the one I talked about in episode 1. These two, the one I'm going to talk about next and the one I talked about in the first episode of this Dodgy Deals kind of series that I've made here, those are competing with one another for being very, very dodgy in their own right. But what you'll find with a lot of these owners is they have a number they want. They want 3 million, or they want 5 million, or they want 1 million, or whatever number they want. It could be 50 million, but they have a number they want. And so they will do everything they can to reverse engineer a buyer paying that price. And sometimes that even means just giving you bogus numbers, which is exactly what happened in the next story. This one was in Oklahoma. This was a company that did a number of different home service repairs, including plumbing and HVAC in Oklahoma City. I actually drove down from Nebraska to Oklahoma City, drove through the night to be there in this meeting, sat down with the owner and the owner's representation, as well as one of my business partners. We were in that meeting for 3 or 4 or 5 hours. The business looked really interesting. Admittedly, there were things I didn't like, but there were a lot of things I did like. But when it came down to it, there was literally about $250,000 a year in yearly discrepancies from which the owner simply said, you have to believe me. There was no other justification. They were proposing that the business did almost $1 million a year in take-home profit. We only found about $550,000. Maybe they were proposing it was like $850,000 in take-home profit, and we could only find about $550,000, maybe $600,000 in profit. The tax returns just didn't show more than that. And yet the owner kept telling us, oh yeah, you can trust it, you can trust it, you can trust it. Okay, well, where's the proof? Well, I mean, didn't you already see my profit and loss statement that shows? Yeah, but I can't see the difference between the profit and loss and the tax returns. Where's that extra $250,000? Well, I mean, it's on the profit and loss. Okay, well then why is the profit and loss $250,000 different than the tax returns? Oh, because we use accrual accounting versus cash accounting. Okay, well let me explain that real quickly, and I'm not going to go in too much depth here. Talk to your accountant about the specifics, but you can't use cash accounting versus accrual accounting as a way to either hide or create newfound income. Now, what you can do is take revenue that perhaps was earned just before the end of the year, and you can push that off to the next year, or you can move expenses from one year to the other, right? So if you bought something on December 31st, maybe you don't input it into January 1st, for example, or vice versa, right? So there is a little bit of that you can do, but here's the thing. If you took money that you made in 2018 and you tracked it in 2019, okay, then maybe 2018 is going to look worse, but 2019 is going to look equally that much better in the opposite direction. Right? It's almost like the basic laws of physics. Energy cannot be created nor destroyed. Income cannot be created nor destroyed. Okay, maybe you took your income from this year and moved it over to this year for tax purposes, but then the next year should show that much more income. And the year prior should show that much less. They're directly related. Yet this was a guy that was trying to tell me that, no, you just must not understand cash versus accrual accounting. And that's absolute garbage. And this is really the punchline I want all of you to be aware of. Is sellers will use all these different questionable tactics. They'll give you profit and loss statements that show much more income than the tax returns. They'll use very aggressive styles of depreciation, which make it look like there's more EBITDA than there really is. Not EBITDA, excuse me, but there's more cash flow, I should say, because EBITDA is earnings before interest, taxes, depreciation, and amortization. But, most small business owners and small businesses, they'll value their business based on the total cash flow. And if you have a bunch of depreciation, it's basically free cash flow that you can use to put in your back pocket without paying taxes on it. So it's actually a really delightful thing. Accountants love depreciation. Well, and brokers and investment bankers love to highlight depreciation and make it look like it's going to always be there, when in reality, sellers in some cases will take huge amounts of depreciation now. They'll just totally suck the depreciation out of the assets they're trying to sell, and they'll never say anything about it. And only when you talk to their accountant do you really realize what's happened. So you'll see that. You'll see this cash versus accrual accounting game being played, and they'll try to act like there can be profit on both sides of the aisle, which, look, you can only take the profit in 2018 or in 2019. You can't take it in both. So pick a lane. You want to make 2018 look worse and 2019 look better? Fine. But you can't do it both ways. I understand cash and accrual accounting to know. You just can't double dip. You can't double dip. Right? So they'll use that trick. They'll use the idea that their P&Ls look beautiful, but when you actually see their tax returns, the money's not there. And then sometimes they'll just have their representation, whether it's a lawyer or a broker or a CPA or an investment banker, whoever they have, and sometimes it'll be a combination of those types of individuals. Those people will say, oh, it's absolutely worth this much. And then they'll sign off CPA at the bottom. And then they have all this size 4 font that says, this is not an officially a professional opinion. For a professional opinion, we would have to conduct a formal audit. And so basically, it's their way of getting out of it, right? It's like when you turn on the TV and you see those pharmaceuticals selling you those drugs that are going to get rid of your diabetes, but it may actually blow up your heart or blow up your brain or blow up your kidneys in the meantime. But they have that guy that speaks really fast, and they have the really small print saying that these are all the risks associated with taking this drug. It's the same darn thing these CPAs and investment bankers and brokers do. They say, oh yeah, of course the business does that much. And then right below it in very small print, it says, this is not officially a professional opinion, and this opinion should not be actually considered in evaluating the business, and this opinion should not be in any way, shape, or form used in your final analysis of how much you should pay, and we are not liable for any misrepresentations which we've made in this offering. That's the name of the game. That's what goes on in these small business transactions. And it happens. I've been talking to professionals who have worked on billion and multi-billion dollar transactions. You know, some of the individuals on my team, they have that kind of experience, especially my lawyer and my accountant. And they tell me that same kind of thing happens all the way to the top. Buffett talks about this, that this happens all the way to the top. Faulty accounting principles that owners and businesses and even Fortune 500 companies use to make it look like their company's better off than it is. So they have a higher PE multiple, so they look more valuable, so they can procure more investment, so they can get better leverage at better rates. You know, I mean, business is a cutthroat place, and there's a lot of things you got to keep an eye out for. But those are just a couple of dodgy deals I've seen in the last year. The number one deal was where the owner was literally a slave to the business. The second one was where the owner literally couldn't explain anything about his books or anything about where his expenses were coming from or where his revenues were coming from. And then when the business started nosediving, he just acted like that was no big deal, that I should still pay full price, which was ridiculous. And then there was the Oklahoma deal, where the guy literally was missing at least $250,000 worth of profit, and he just blamed it on accrual versus cash accounting. It was ridiculous, and it's something I avoided like the plague. I recommend you do the same. That doesn't mean you just give up. You got to keep moving. You know, we made another offer after everything that happened with our most recent deal. We pulled out of almost a $3 million deal just 2 days ago. And so then yesterday I made a $2.3 million offer on another company that looks really great. But of course, I'm going to do my investigation. I'm going to do my due diligence. You can't get romantic about the deals. You can't get your heart too engaged. You got to be cutthroat. You got to be smart. You got to stay optimistic, but that doesn't mean you get romantic. That would be my last point to leave on this video. And with that, be sure to subscribe to the YouTube channel for more deal making, business, real estate, and M&A content. Thumbs up the video if you've liked this thing. And for more, go to jasonpaulrogers.com. Hey, it's Jason Rogers. Thank you so much for watching the video. Be sure to subscribe, thumbs up the video, and for more, go to jasonpaulrogers.com.